Well, look, the pound's been very overbought, particularly against, say, the Swiss franc. It's also relatively overbought against the dollar. So we're actually recommending short positions, particularly short-term in the pound. But that's not to say that all is not well with the UK economy. Actually, I think there's probably too much pessimism towards the UK generally and towards the overall and eventual impact of Brexit, which we think will be relatively benign. So actually, the outlook for the UK is fine. Sterling, I think the move is probably to the downside at least in the short term, but mainly for technical reasons.
You think it will be a relatively benign impact. You may have heard Mohammed Al-Arian there telling me that, in fact, he thinks Mark Carney has a real stagflation issue on his hands. Do you agree then?
Well, certainly there's some softening of growth recently. There's a little bit of uncertainty with respect to investment in the UK. But if you think about longer-term growth for UK, unfortunately, the way we run our economy is by getting house prices up, generating a wealth effect, and seeing better consumption. And a lot of that relates to, of course, house prices and mortgage rates that keep falling. It doesn't really relate to trade. We're not a trading hub. We're not like Germany. Our growth isn't driven by trade. And so if those domestically driven dynamics continue, which are largely Brexit independent, then I think the UK growth outlook is probably fine, albeit it's linked to and will create lots more structural problems down the road.
But Harry, if you have a look at it, and I have to admit that I'm probably one of those people who are a bit bearish in terms of the outlook for the UK economy, if it's all dependent on consumption, then that means it's all dependent on consumption spending and ever-increasing levels of personal debt. And in a rising interest rate environment, however gradual that's going to be, that obviously can't really be sustained, right?
Well, eventually, you're right. You're in that kind of environment. As soon as money tightens, then structural vulnerabilities really start to matter, and economies roll into recession. And that's what we've seen in the last crisis, and indeed recessions before that. But until the party stops because of cheap money, it keeps going. So in that respect, I think the UK is fine.
And Harry, with that, the party keeps on going, apparently at the ECB as well. Yes, normalization, but it's also going to be very gradual. What is your Euro call, especially now that we've cleared two big events coming from the U.S., that in the way of the new Fed chair, and starting to get more details on this tax agenda?
Well, there are lots of net long speculative positioning in the euro, back up at close to multi-year highs in the euro. And the interesting thing to me is the speed of that move lower in the euro, I think probably marks the beginning of a phase of euro weakness. And interestingly, if you look at the rates market in Europe, all year the rates market has been trying to price in hikes. They tried it in March when the ECB said they've defeated deflation. They tried it in June when Draghi gave his speech in Portugal. And finally, I think the rates market is beginning to give up on this idea that the ECB will tighten. They've had a very strong euro, which is deflationary. I think the outlook for the European economy is relatively weak. I think the rates market is rightly now beginning to give up on this idea that the ECB will tighten with any kind of speed, and that should translate into further euro weakness.